In today's world, financial literacy is not just a skill, it's a necessity for independence and security. Studies show women are significantly less likely to invest than men, despite living longer and often needing to stretch their savings further. A 2021 Fidelity study found that while 67% of women are saving money, only 33% are investing outside retirement accounts. This gap represents millions in lost potential wealth. The good news is that investing is far more accessible than most people realize. With the right knowledge and tools, any woman can start building wealth, regardless of income level or financial background. This comprehensive guide will walk you through exactly how to begin investing in stocks, ETFs, and real estate while addressing the unique financial challenges women face. The female financial advantage and how to use it. Contrary to popular belief, women actually make better investors than men when they participate. Research from Warwick Business School found women investors outperform men by 1.8% annually, primarily because they trade less frequently, take a more research-based approach, and hold investments longer. Yet the gender investing gap persists due to several factors, including a confidence gap, where nearly half of women say they need to know more before investing compared to just 28% of men. Many women also perceive investing as riskier than it actually is, and caregiving responsibilities often leave less time for financial education. The solution starts with recognizing that investing isn't about having extra money. It's about making the money you have work harder. Even small amounts invested consistently can grow substantially over time thanks to compound growth, which Albert Einstein famously called the eighth wonder of the world. Building your financial foundation. Before diving into investments, it's crucial to establish solid financial fundamentals. First and foremost, financial experts universally recommend saving 3 to 6 months' worth of living expenses in an easily accessible emergency fund. This safety net prevents the need to sell investments during market dips or personal emergencies. High-yield savings accounts from online banks like Ally or Marcus typically offer significantly better interest rates than traditional brick-and-mortar banks. When it comes to debt management, not all debt is created equal. The most strategic approach is to first pay off high-interest credit card debt, typically 15 to 25% interest, then tackle personal loans, 5 to 10% interest, while potentially continuing to invest even while carrying low-interest debt like mortgages, 3 to 6% interest. Understanding your personal risk tolerance is another critical foundation piece. Your investment choices should align with your time horizon, when you'll need the money, your emotional comfort with market swings, and your current financial responsibilities. Many major investment firms like Vanguard and Charles Schwab offer free online risk tolerance quizzes that can help determine your ideal asset allocation between stocks, bonds, and other investments. Stock market investing demystified. Buying a stock means owning part of a company, with returns coming from price appreciation and dividends. The S&P 500 has historically returned 7 to 10% annually over 20-plus years, despite short-term volatility. Beginners should start by selecting a brokerage. Fidelity and Schwab offer strong research tools, while Robinhood provides a simple interface. Fractional shares make investing in high-priced stocks accessible. Diversification is key. A balanced portfolio might include 50% index funds, 30% dividend stocks, and 20% growth stocks. Avoid chasing trends, panic selling, or over-concentrating in employer stock. Smart investing requires patience, research, and a long-term mindset. ETFs, the smart investor's shortcut. ETFs have revolutionized investing by providing instant diversification at remarkably low cost, making them particularly ideal for beginners. These innovative investment vehicles combine the best features of stocks and mutual funds. They trade throughout the day like individual stocks, but hold a diversified basket of assets like mutual funds. The advantages of ETFs are numerous, starting with their significantly lower fees compared to traditional mutual funds. While the average mutual fund charges 0.5 to 1% annually, many high-quality ETFs cost just 0.03 to 0.20%. ETFs also offer superior tax efficiency, generating fewer taxable capital gains distributions than mutual funds. Their flexibility allows investors to buy and sell shares anytime during market hours, unlike mutual funds which only price once per day after markets close. Constructing a simple yet effective ETF portfolio can be remarkably straightforward. Many financial experts recommend a basic three-fund approach that covers all the essential bases. Approximately 50% in a broad U.S. stock market ETF like VTI, 30% in an international stock ETF like VXUS for global diversification, and 20% in a bond ETF like BND to reduce overall portfolio volatility. As investors gain more experience and confidence, they can consider adding specialized ETFs that focus on particular sectors like technology or healthcare, thematic ETFs that track emerging trends like clean energy or artificial intelligence, or dividend-focused ETFs designed to generate steady income streams. Real estate investing options. Real estate is a proven wealth-building tool offering passive income, appreciation, and tax benefits. Rental properties generate cash flow but require capital and management. House hacking, living in one unit while renting others, offers a lower-cost entry. For a hands-off approach, real estate investment trusts, REITs, provide exposure without ownership hassles. REITs like VNQ or Realty Income O pay high dividends and trade like stocks. Crowdfunding platforms like Fundrise let investors pool funds for real estate projects with low minimums. While offering potential high returns, they lack liquidity and should complement a diversified portfolio. Real estate suits various investing styles. Retirement accounts. The tax advantage. Smart investors understand that where you hold your investments can be just as important as what you invest in. Tax-advantaged retirement accounts offer powerful benefits that can significantly enhance long-term wealth accumulation. Employer-sponsored 401k plans should be the first stop for most working investors, especially when employers offer matching contributions. This is essentially free money that provides an immediate 100% return on your investment. The decision between traditional 401k contributions, which reduce your current taxable income, and Roth 401k options, which use after-tax money but allow tax-free withdrawals in retirement, depends largely on whether you expect to be in a higher or lower tax bracket during retirement. Individual retirement accounts, IRAs, provide additional opportunities for tax-advantaged savings beyond workplace plans. For 2024, the contribution limits stand at $7,000 for those under age 50 and $8,000 for those 50 and older. The choice between traditional IRA and Roth IRA follows similar logic to the 401k decision. Traditional IRAs offer upfront tax deductions, while Roth IRAs provide tax-free growth and withdrawals. Roth options often make particular sense for younger investors in lower tax brackets who anticipate higher earnings and tax rates later in their careers. Health savings accounts, HSAs, represent perhaps the most tax-efficient investment vehicle available when used strategically. Often described as having a triple tax advantage, HSAs allow tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. After age 65, HSAs effectively function like traditional IRAs, permitting withdrawals for any purpose, though non-medical withdrawals become taxable. For those eligible to contribute, which requires being enrolled in a high-deductible health plan, maximizing HSA contributions each year can create a powerful supplemental retirement savings vehicle. Overcoming psychological barriers. Many women face unique psychological hurdles when approaching investing, but understanding and addressing these barriers can unlock tremendous financial potential. Imposter syndrome, that persistent feeling of not being knowledgeable enough, affects many new investors, especially women in male-dominated financial spaces. Practical solutions include starting with paper trading accounts that allow practice investing without real money, joining women-focused investment communities like Ellevest's network, and remembering that many confident male investors actually overestimate their knowledge, while women's more measured approach often leads to better decisions. Time constraints present another common challenge, particularly for women balancing careers with disproportionate caregiving responsibilities. The solution lies in implementing efficient systems that make investing automatic and integrating financial education into existing routines. Setting up automatic transfers from checking to investment accounts ensures consistent investing regardless of busy schedules. Dedicating just one focused hour per week to financial education, perhaps while commuting via investing podcasts or during a morning coffee break with a personal finance book, can yield significant knowledge gains over time. The key is recognizing that you don't need to become a Wall Street expert to be a successful investor. Consistent small actions compound just like money does. Advanced strategies for growth. Experienced investors can optimize returns with advanced strategies. The choice between dollar-cost averaging, DCA, and lump-sum investing is key. While DCA reduces timing risk, lump-sum investing has historically outperformed 2/3 of the time. A hybrid approach balances risk and reward. Tax loss harvesting helps reduce taxes by selling losing investments to offset gains, with replacements maintaining market exposure. Robo-advisors now automate this strategy. Sector rotation aligns investments with economic cycles. Defensive sectors perform well in downturns, while cyclicals thrive in expansions. While most investors benefit from consistency, active investors may adjust portfolios based on market conditions. Time is the most powerful factor in wealth building. Investing $300 monthly from age 25 can grow to $1 million by 65 with a 7% return, but waiting until 35 requires nearly $700 monthly. Starting early, even with small amounts, is key. Consistency matters more than market timing. Downturns are opportunities, not disasters. Financial freedom offers security and choices. Open a brokerage account, automate investing, and take action. Books like The Simple Path to Wealth and communities like Ellevest provide guidance. Wealth building isn't exclusive. It's available to anyone willing to start and persist. Your future self will thank you. If you found this video informative, make sure to subscribe to this channel for more content.